Hello, everyone. Stephen Mead here with Domicile Real Estate, where we are on a mission to help Southern California's renters become homeowners. This week, we have another quick tip for you on a topic that a lot of you have asked about. This comes up in our webinars very frequently, and that is, are property taxes and insurance part of my mortgage payment? And that's a really great question, and the answer will take us just a couple minutes, but it's really worth it to understand how this works. If you are putting less than 10% down, which is what most first-time home buyers do, then you don't have an option. Your taxes and insurance will be part of your mortgage payment. If you're putting more than 10% down, you actually have an option. But even if you have an option to not have them part of your payment, we recommend that you do, and there's a couple reasons why. In California, property taxes are actually due 2 times a year. They are considered delinquent. There's one payment that is due in the middle of April, and another payment that is due in the middle of December. And as you'd imagine, these property tax payments are actually pretty big because they take all the property taxes for the whole year and they divide it into 2 payments. And similarly, your homeowner's insurance, which is what covers you against like a fire or your home being broken into or vandalized, that insurance is typically renewed once a year. So it's not like car insurance where it's every 6 months. It's annual. So you buy your first year of insurance when you buy your house, and then a year later it comes due for renewal. And this is the way the lenders have figured it out, especially for first-time home buyers, and it works out generally pretty well. Instead of relying on you to make that property tax payment twice a year and to renew your insurance, what they do is they figure out how much those insurance amounts are, how much your property tax amounts are, and then they add that as a monthly amount to your payment. So what they do is every month, part of your payment goes into an account. It's called an impound account or an escrow account. Different lenders use different terminology for it, but it's an account in your name. And as time goes on, the balance builds up every month as part of your monthly payment. And then when the property taxes are due, they will actually make withdrawals from those accounts. And the nice thing about this system is that you're not really giving your money to your mortgage lender. It's an account held in your name, so that if you ever pay the loan off or if you refinance your mortgage, they are actually required to pay you whatever money is left over in that account back. It is your money. They are just holding it onto you and making the payments as a convenience to make things easier for you. Anyhow, I hope that helps maybe clarify some of the misunderstanding about this. If you have any other questions, comments, of course, we'd love to hear from you. And if you'd like to schedule a no-cost 15-minute consultation, just let us know. We can do that virtually too. And we will see you next week.